Look, I think we should stick to exactly what we said, which is that given where we are, given the information we have, we don't see, we think that the policy rate we are at is sufficient to, put us firmly on the disinflationary path. If there are surprises, and surprises could occur with every sort of change in data, if the surprises are thought of as durable enough, so we will try and look through transient shocks to inflation, we will have to act accordingly. Surprises could be on both sides. Yesterday, for example, we had the CPI industrial worker come in at a astonishingly low 6.7. I thought that was interesting, but again, it seems like food is still a big part of it. It's not the other factors. But as the other factors start waning, we may get some surprises which are positive for the economy. But there could also be negative surprises, and we all know what they are: food shocks and so on. So we have to wait and see. That's our anticipation, that we will be firmly on the path. I think that if maybe I'm just repeating myself, if there are surprises, we'll have to act accordingly. But as of now, we believe that the rates are set at a level consistent with reaching that path.
6% in 2016.
You see, as disinflation kicks in, the effective real rate, even at this policy rate, will start increasing. And so that will create some disinflationary momentum. Now, let's wait and see. We have to see. You see, it's early days yet. We have seen some disinflationary impact in services. That services inflation is coming down. So until we watch this for some time, neither you nor I, because this is a new economy. This is not the economy that was there 2 years ago. It's not the economy that was 4 years ago. So we don't have very precise judgments. Nobody can have of how rapidly the disinflationary process will proceed. Let's wait and see. The reason we gave both a number and a date is that we want to make people feel comfortable about the pace of the disinflationary process. If, for example, we feel that with the current level of interest rates, if we kept it where it was and we felt we would hit 6% way before January of 2016, that would suggest that the pace of disinflation may be stronger than we necessarily would want, and we would have the room to cut interest rates at that point. If, on the other hand, we find that inflation has come down, but that in order to hit that 6%, it would have to keep coming down, and that we would just barely hit that 6% at the end of January 2016, we would have less of an incentive to cut interest rates. The RBI is a regulatory organization. It is run by technocrats. We are apolitical. We don't take a political stance either way. The key would be whatever new government comes, whether it's some of the old or some new, to build relationships with that new government. A critical relationship in the health of the country's economy is between the Reserve Bank of India and the Finance Ministry. It's not a one-way relationship. There's give and take on both sides, but it's an important relationship to make things work smoothly. It should not be an antagonistic relationship. So that is something that we will have to work on. Relationships have to be built with whatever happens in the Finance Ministry. Now, usually a number of the bureaucrats in the Finance Ministry stay on. So relationships that have been built with the bureaucrats will continue, and the then the key relationship that has to be rebuilt is with whoever happens to be the new finance minister. On the public sector banks, I think that capital is important. The government will have to find, the capital to bear its share, or at some point decide that it wants to give up some share. That's a constraint that it will have to face. I think what is important from the perspective of the public sector banks over the next 5 years is create more confidence in the profitability and governance, therefore profitability of the public sector banks, so that they can sell their shares at a healthy price and thereby raise capital through the normal process that everybody else raises capital. So first, increase profitability themselves. Second, increase the anticipation of profitability over time by improving governance and the management structure. Those are things that we are, talking to the government about. That there have been some ideas that have been proposed, and as the new government comes in, more discussions will take place. So I think I'm not too worried about capitalizing the public sector banks if there is an appetite for changing for reforming the governance and management. I think capital will then come in, and we won't have as much difficulty. The problem will arise if there is no appetite for reform, because talking to the public sector CEOs themselves, you see that many of them know exactly what needs to be done, but need to be given the space and the time to do what is needed. So it's not so much ownership which is the issue, it is whether the current ownership will allow the governance and management that is needed to emerge. So that's something that needs to happen.